Fixed income. Fixed income in CFA Level 1 focuses on debt securities, bond markets, valuation principles, and risk analysis used in investment management and credit assessment. The curriculum introduces the fundamental characteristics of fixed income instruments, including coupon structures, maturities, indentures, and covenant protections for investors and issuers. Candidates study how fixed income securities are issued and traded in primary and secondary markets and compare government, corporate, and securitized debt markets. The topic also explains the role of fixed income indexes and the participants involved in global bond markets. Understanding fixed income instruments is essential because bonds are widely used for income generation, diversification, capital preservation, and risk management. Fixed income provides the analytical framework needed to evaluate debt securities and interest rate environments effectively. A major component of the fixed income curriculum involves bond pricing and yield analysis. Candidates learn how to calculate bond prices using yield to maturity and understand the relationships among price, coupon rate, maturity, and market interest rates. The curriculum explains matrix pricing, yield spreads, annualized yields, and money market yield conventions for fixed-rate and floating-rate securities. Candidates also study spot rates, forward rates, par curves, and the term structure of interest rates to understand how future interest rate expectations influence bond valuation. These valuation principles are critical for assessing relative value and investment opportunities within bond markets. Understanding yield measures and pricing relationships enables investment professionals to evaluate fixed income securities accurately and interpret changes in market interest rates and credit conditions. Interest rate risk measurement is another critical area within fixed income because bond prices are highly sensitive to changes in market yields. Candidates study holding period returns, Macaulay duration, modified duration, money duration, and price value of a basis point as tools for measuring interest rate sensitivity. The curriculum explains how maturity, coupon rates, and yield levels affect duration and overall price volatility. Candidates also learn convexity concepts and how duration convexity analysis improves estimates of bond price changes resulting from yield movements. Portfolio duration and convexity calculations help investment professionals evaluate and manage interest rate exposure across diversified bond portfolios. These analytical techniques are essential for portfolio construction, risk management, and understanding how changing interest rate environments affect fixed income investments and portfolio performance. The curriculum also examines advanced risk measures and the analysis of bonds with embedded options. Candidates study effective duration, effective convexity, and key rate duration, which provide more accurate measures of price sensitivity for callable and putable bonds. The curriculum explains the difference between empirical and analytical duration and highlights the importance of benchmark yield curve analysis in managing fixed income risk exposures. Candidates learn how changes in different segments of the yield curve affect bond prices and portfolio performance. These concepts improve the ability to evaluate complex fixed income securities and manage portfolio risk more effectively. Understanding curve-based risk analysis enables investment professionals to design strategies that respond appropriately to changing interest rate expectations and evolving market conditions across different maturities and credit sectors. Credit analysis is a major component of fixed income because default risk significantly affects bond valuation and investor returns. Candidates study the components of credit risk, including probability of default and loss given default, along with the role and limitations of credit rating agencies. The curriculum explains how macroeconomic conditions, market factors, and issuer-specific characteristics influence credit spreads and bond risk. Candidates also evaluate sovereign, non-sovereign, and corporate borrowers using qualitative and quantitative credit analysis techniques. Financial ratio analysis, debt seniority structures, secured versus unsecured debt, and bankruptcy priorities are also examined. Understanding credit risk allows investment professionals to assess issuer creditworthiness, estimate expected losses, and make informed investment decisions across government and corporate bond markets globally. The fixed income curriculum concludes with securitization and structured finance products, which are important components of modern financial markets. Candidates study asset-backed securities, mortgage-backed securities, covered bonds, collateralized debt obligations, and commercial mortgage-backed securities. The curriculum explains the securitization process, including the roles of issuers, investors, servicers, and credit enhancement mechanisms. Candidates also learn about prepayment risk, tranching structures, and the unique cash flow characteristics and risks associated with securitized products. Understanding securitization helps investment professionals evaluate complex fixed income instruments and analyze how structured products redistribute credit and cash flow risk among investors. Fixed income therefore equips candidates with comprehensive analytical skills needed to evaluate bond markets, manage risk exposures, and support investment decision-making across global debt markets.